Hi, and welcome to Random Rogers Big Picture, special Daylight Savings Edition, if you happen to live in one of those 48 states where they actually do fiddle with the clocks. Of course, here in Arizona we don't. Two things on the docket this week. One, March Madness basketball is already looking good, and then an article I found on Seeking Alpha about hedge funds. First, the basketball. I'm doing this video Friday afternoon. There's been two great games, the Kentucky going down to Mississippi State and BC coming back and beating Miami in overtime. And Bucknell came back and gave Holy Cross a game toward the end there after being down what I think was about 16 points at one point. Maybe it was worse than that. I kind of only had one eye on the game. But so basketball's off to a good start. The main part of this week's video is going to be an article that I found on Seeking Alpha. It's written by a guy named Carl Delfield, who you may know him. He pops up here and there. I believe he writes something for Forbes, some online newsletter thing. Quite frankly, I'm not sure how much this guy knows. I don't know how smart he is. Obviously, he's no idiot to be on Forbes in the manner that he is. But I'm just not sure how much he knows. And that's kind of a thing where you start to read someone, and sometimes you get a feel for what they know, and sometimes you don't. He's had a couple of interesting picks over time, but I would not say that he's ever said anything truly enlightening on, of something truly enlightening about exchange-traded funds. So, maybe he's got that in them, maybe he doesn't, but it's always good for a read. So there's a post on Seeking Alpha by him that I will put on underneath the picture for this video, where he talks about making your own global macro hedge fund and using ETFs to do it. And he's got a couple of things that I guess I would either maybe take issue with or point out may not be the best way to go about doing it, or maybe just something that I would say I disagree with. First, he talks about an exit strategy. I'm all for having an exit strategy, to be sure, but I'm a little fuzzy on having kind of just an arbitrary exit strategy, because sometimes they're just that, they're arbitrary. What he advises here is selling something if it falls below its 200-day moving average, or if it falls 8% below its trailing high. Well, I'm not so sure that this is necessarily going to be the thing for all times. My thinking being that, if you look at last week, when we had the correction, so if the broader market was down 4 point whatever percent last week, then obviously some things are going to be down more than that and some things are going to be down less than that. If you have one big kind of whooshing, if that's even the right word for last week's sell-off, I'm not sure, and it's based on something that isn't necessarily fundamental to the holdings, I'm not necessarily sure that selling into that is really the right thing to go. It was, in broad terms, such a small decline that I'm not sure it makes sense. And then once you sell, well, then what do? If you believe in having a diversified portfolio, and elsewhere in the article he talks about having no more than 20 ETFs, if you sell, your whatever it is you use for financial exposure, let's say, if that drops 8%, you bought it because you must have thought it was the best financial holding you could find. And so if you sell it because it goes down 8% arbitrarily in some sort of broad sell-off, well, then what do? When do you get back in? Do you pick something else? It just opens up a Pandora's box, I think, to quite a few different problems, and I just don't think it's ideal to just arbitrarily do that. I think, if you have a bigger picture strategy of when to get defensive, for mine it's when the market goes below its 200-day moving average. I kind of take a little bit here and there. I don't sell an entire holding because I do want to maintain a diversified portfolio no matter what's going on. Maybe that means, at one point in the cycle being, 95 or 100% invested in stocks, and maybe at another portion that means being 70% invested in stocks or some other number. The point being is that whatever I've got exposed to stocks, I want that portion to be diversified. That's a very important thing to what I'm trying to do for clients. Hi, Tater. What I'm trying to do for clients, and it also minimizes the consequence of getting some call like this wrong or some trade like this wrong. You know, it's easy to get stuff wrong, but how the manner in which you go about acting on this and how you're wrong is what ultimately determines the consequence for being wrong. Hopefully that makes sense the way I'm saying it. He also, you know, the article really is a good read, but I think, especially where you're talking about 20 ETFs and, you know, kind of limiting it to ETFs, which I don't think he's actually advocating, but for sake of the article is what he's talking about. When you limit yourself in that manner, it potentially makes the job kind of difficult. This, as I read this, seems like a complicated thing. Everyone who visits the site by now knows reader Tom Kay. He's got a very detailed model that works. I'm not minimizing it doesn't work, but as I read it, it doesn't strike me as being simple. It probably works, seems like it works. Tom's only been, I think, leaving comments for maybe 6 months or so who knows? But it's not simple. No matter how great or how terrible it is, not simple. And that's kind of the thing that, where possible, I do try to make, you know, my job of constructing and then managing a portfolio as simple as possible. That's a pretty important thing. And here, you know, to the extent where I think about making my portfolio, or client portfolios more specifically, a global macro hedge fund, yada, 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 I didn't really think of it in those terms. I think of the core as being a, you know, diversified equity portfolio. And from there, what can I add to maybe reduce correlation when I think that's a good idea? Add diversification, even if correlation right here, right now, doesn't need to be reduced. That's kind of what I'm trying to do, and really just do that with maybe 3 or 4, maybe 5 holdings at the most within the context of a diversified portfolio. To me, that's simpler. If what is written here seems simple to you on the Seeking Alpha post, if that seems simple to you, by all means go for it. But strikes me as a little complicated relative to just maintaining a diversified portfolio with a few tweaks here and there. Have a good weekend. Enjoy the basketball.